Welcome to the daily update, where I'll go over the action in the market for Wednesday, November 26th, and we'll see how things look for Friday, November 28th. All right, looking pretty positive now. We are concerned because growth is just not outperforming value. Now, we like it that there's broader participation in the market, but we're not seeing a lot of that offensive push to the positive side to make the market more offensive. It's still looking like it's getting more defensive, but in the meantime, we're not too far from an all-time high. We're back to positive on all time frames. So when you look at the index itself, it's doing really well, and we seem to be repairing this damage as the market's really starting to assume that now there's going to be a rate cut in December. But at the same time, we want to say, okay, is this kind of a setup here? We still are not seeing growth doing all that well on a ratio basis. Now, this could always kick back into gear. People could go over the holiday weekend and then come back on Monday and say, I'm going to buy all these growth stocks. And we could totally change that. That's certainly possible. But we've been seeing this build for a while. And then of course, we have a holiday weekend that leaves the door open for something weird to happen. Let's really hope that's not the case. But we live in crazy times and crazy things happen. So, anyway. Before I get into this, I want to wish everybody a happy Thanksgiving. I enjoy doing these videos. I've been doing them for decades. I've been in the markets for decades, and I'm thankful that I get to share the experience and the knowledge that I have with you, and that is just something I like to do as an educator. So I want to wish everybody a very happy, safe, and blessed Thanksgiving. Also, from now until the end of 2025, we're coming up a little bit more than a month now from that. I have a thing called the SPX Investing Program. Check it out. It's free. You get immediate access to the videos, and there's additional information there. There's strategies that we talk about. You could set up a time to talk with me. So feel free to check that out. There's really two parts. There's one where if you go to Substack, you have to provide payment information, even though you're not charged anything. And then there's another site called spxvideos.substack.com where you get immediate access to the videos and you don't, at least till the end of 2025, have to provide any payment information. So check that out and see if that is of use to you. All right, so going back over what happened on Wednesday, we did have a higher open. There's some optimism coming back in. We do have positive seasonality, and that seems to be carrying things in the more upward direction right now. So we had a higher open. We climbed above 6,800. So we're back above that level now, and R1 at 6,808. We held on to the gains. We didn't really see any selling going into the close. We just kind of drifted sideways. We came down just a little bit and ended up closing slightly above R1. So we were up 0.69% and not really surprising. Volume is below average. All right, yeah. It's the day before a holiday, and then Friday is going to be a shortened day, so we'll be below average there. Folks are more focused on Thanksgiving and possibly traveling and cooking turkeys and watching football and all the great things that happen over Thanksgiving. So we're positive on all three time frames measured by the moving averages, short, intermediate, and long term. We're actually dropping a little bit below 4% with the 10-year yield. Now, again, we've been seeing this for a while now. The last patterns have been before we have a Fed meeting, which will be on the 10th. So we still have a ways to go until that meeting is going to happen. And eventually the Federal Open Mouth Committee people, they'll be blacked out. They won't be able to talk anymore and give their speeches. But we've seen the 10-year yield going down, and then once the Fed comes in and cuts rates, then the 10-year yield starts to go back up. It defies logic. You would think it would be just the opposite, but that's what we've seen recently. And we did receive some economic reports. Some of them are kind of delayed. Some of them are more close to what's happening right now. I'll go through those. And things seem to be shifting back over and looking a little bit more positive. But there are concerns, and I'll show you that as we go through the different charts. Okay, so some comments. It was a broad-based advance, and tech and semis actually participated in Wednesday's session. So that was encouraging. We want tech to do well. We want semis to do well. We want semis to do even better than tech. That's when the market shows more of an aggressive, positive stance. So that part is holding up. And there's the optimism about the December rate cut that just continues to grow. And small caps and mid caps, they like the fact that interest rates may be cut, so they're going up now. And in the negative side of things, we still have this confirmed Hindenburg omen. Now, on the positive side, it's not quite there yet, but we potentially have a ZWAG NYSE breadth thrust. Now, it hasn't been confirmed. We saw the first part of a ZWAG NYSE breadth thrust when we had that big down day last Thursday, a week ago. And now we've been coming up since then. Are we going to be able to get that extreme positive reading that we need, which is called a breadth thrust, and then see that actually come through? And I'll show you that chart. We're not there yet. All right, and we're seeing some momentum build up in the positive with the short term here, with the Stochc RSI, Williams percent R, and stochastics. Those are starting to show more extreme positive readings, which in this context, we see it as positive conviction. And we're even seeing a little bit of an extreme reading with the PMO studies. And again, I'll show you charts of all these things here. And then the scenario with the Fed, where we were looking like we were going to get a rate cut. And then after the last meeting, Chair Powell and then some other members came out and said, well, may not end up happening. Now folks are coming back and saying, yeah, that might happen. And now the market's taking that and running with it. And so it's becoming more likely that there might be a rate cut in December. The dollar was down. That's probably helping stocks there. And we're just a little bit below 4% with the 10-year yield. We're still extreme negative with sentiment. It's like you have a lot of folks that aren't trusting this, and that's exactly what the market likes if we're going to turn back and look more positive. Where we're still way below that 25 level, coming in at 18, where we had been at 60. Now, this is an improvement. The context is because we were at 6, and we got to 11, and we made it up to 14, then 16, now 18. So the context is that we're going up here, but we're still getting an extreme reading with the number itself. It's below 25. And we're still not trending though, but we're switching back and looking more positive here. The green line's above the red line, but we're below 20. We're below the moving average. With the update, the bias is positive and the momentum, I'm still keeping it mixed to positive, mainly because we're not seeing a real thrust in the growth area, at least yet. Okay, then we got a whole slew of reports. There was a lot longer list, but a lot of them had delayed at the end of it here. So I'm just going to go through the ones that actually came out. This is still looking good from the employment situation area of things. Initial claims at 216,000. That's less than the 225,000 that was expected. So folks getting laid off, that's not really showing any weakness right now. And continuing claims were still up in the 1.9 million range, but we're also below that 2 million range. But we have switched over into a higher sideways pattern that we've been in now for a while. Durable goods came in stronger than expected, up 0.5%. They expected 0.3%. Last time it was up 3%, but this was greater than expected. It shows, okay, maybe the economy is doing pretty well here. And then if you take out transportation, also up more than expected, up 0.6%. They thought it would be up 0.2%. Last time it was up 0.5%. Chicago PMI did come in weaker than expected at 36.3. They expected 44.5. Last time it was 43.8. And then every week we get the mortgage applications. It was up 0.2%. Last week it was down 5.2%. And then the Fed comes out near the end of the day with this thing called the beige book, because that's what the cover looks like. And it really didn't report anything that was all that drastic since the last time we had this report. The market doesn't really pay attention to this. We just kind of like to know about this to see if anything weird is happening, either positive or negative. Okay, so weekly jobless claims are coming down at the lower end of this range that we've been in for a lot of 2025. That is not posing a problem. We are up in a higher range with the continuing claims, but still we're kind of not really breaking above that 2 million level. So we put it together where the red line, we see initial claims going down, maintaining a little bit higher range with the continuing claims. And then last week we did get the unemployment rate at 4.4%. Yeah, durable goods orders above zero, going up on a year-over-year basis. That's positive, showing economic growth there. If you take out aircraft, still going up over the 5% level. And then month over month, it was up, but up less than what we saw last time. And then the real GDP, we got another update with that. That's still looking pretty good. That's showing economic growth. So the GDP itself is going up. That's the blue line, and the deflator's going down. That's like the best of all worlds there when you see growth up and inflation down. And then the Chicago PMI did drop off. So that was a little weaker than expected, but that's more regional for the Midwest. Mortgage applications, positive this week, where last week they were negative. All right, and then looking at the dot-com melt-up analog, a lot of folks, and there's some wisdom behind this. They're trying to compare what was happening in 1999 and 2000 to what's happening now. There are some similarities, as you can see here by this chart. So if we stick along that line, then we still have some more upside to go here. There are also a lot of differences this time. So to try to compare them as apples to apples is not necessarily fair, but still, it's just another bit of information that we can look at to say, okay, things kind of really got out of hand there during the dot-com boom and then fell apart completely in the dot-com bust. Are we going to end up seeing something like that happening this time? And the financial conditions index, it had really been coming down here, and now it's starting to go back up here a little bit tighter. That could end up putting some pressure on the markets if both this dark blue line and then this other line continue to go up as well. So the fact that this has been dropping overall, that's really been giving some more liquidity to the market and making it easier for stocks to be bought rather than sold. And then 35% of stocks in the S&P 500 are in a bear market, which means they're down more than 20%. Yeah, it's not across the board. Now we're seeing some improvement with the value stocks and stocks that have really lagged behind, but that means the market is generally getting more defensive. It's still a smaller basket of stocks that are really driving the indexes. And then probability of a recession, not really high right now, coming in a little bit above the 20 level. And you look at other charts, and I go through these charts that I have over the weekend, and the market's not concerned about a recession or interest rates. Now, that could always change. That's why we look at these charts on a pretty regular basis. But this chart and other charts that I have also confirm that the market's not really worried about that. And then we look at valuations. Yes, we're overvalued in the US, but we've been there for a long time. And we're more fairly priced if you take out tech, because tech's the big growth area. That's also the overvalued area. And then comparing it with the rest of the world on a valuation basis. Then profit shares remain high so far. So just kind of hanging out here, and that's good. This is companies are able to make profits, and that's staying up pretty high. And then every time we get retail sales, which we did get earlier in the week, we are coming down a little bit here, but we've kind of started a plateau. Now, we rarely see a real decline. We saw that, of course, in 2008. That was a great financial crisis. And, of course, the COVID crash when everything was closed. But the fact that this is kind of going sideways, sometimes that's what happens because people still need to buy things, even though we're possibly in a recession. But that doesn't seem to be an issue right now. And then Turkey Day inflation. Basically, the takeaway from this is we're not seeing much of a change from what we saw a year ago because inflation was really having a problem back in like 2022. And of course, everybody was complaining about it, and they like to make these charts to say how much does it cost to put on a Thanksgiving meal. And then it started to come back down, and maybe a few things are still going up a little bit, but it's not changing all that much. And durable goods, this is also good for the economy. It says the worst of business uncertainty caused by tariffs is most likely behind us. That when I see something like that, then I go, okay, maybe it's not behind us. I tend to take a contrarian view with these things. But right now, it's looking pretty solid. And this could be true. Orders for core capital spending, when you take out aircraft and defense, they rose 0.9% and seeing a pretty strong quarter here. And then the growth rate on a 3 month annualized pace. Okay, 3 month annualized pace. Very good. All right, and then equity flows, a lot of money still going back into the market, not a real surprise there. And hedge fund flows, we're seeing hedge funds coming in and buying. Now, one thing, hedge funds might be big money, but they're not necessarily the smart money, so we don't really want to trail what they're doing. What we want to do is figure out what the real smart money is doing and then follow what they do. But a lot of money's coming back in. So hedge fund buying was the largest over any 2 day period in a long time, one of the largest in the past 2 years. So yeah, are we getting ready to switch back over and look more offensive? Our charts are improving, but we're not in that ideal situation where we see really sustained growth, at least yet, but that could change. Then look at the MOVE index, which measures the volatility of bonds, and then looking at the NDQ here, and they're pretty much in here. That's the NASDAQ 100. I refer to it as the NDX, and they're moving more in lockstep with each other right now. All right, so here's the chart. It wasn't a real exciting day. We had a higher open here. Then we got up to R1 and then just kind of trailed higher, drifted off, and then saw a little bit of a drop down going into the close. And then things are pretty quiet. And they, unless something really crazy happens, that's what we want. We want things to stay pretty quiet with the futures over a holiday. That's typically an American holiday. All right, and then we are improving with our intraday growth and value charts here. They're coming back up after we had been seeing them trailing down and improving here, but not showing real upward thrust. This is one of the issues I've been talking about. We look at the intraday growth and value ratio. So it's positive, but we want to, when we come back next week, because Friday's kind of, it's a half day and a lot of people will be probably taking that off. We would really like to see this ratio go up with some real conviction. All right. And then so growth was up and it was about even with value. And it was up a little bit more with the mid caps and a little bit less here with the small caps. So we're seeing a general improvement with small cap growth to value. Mid cap growth to value. It had been becoming quite weak. It actually ticked down a little bit here. This is not showing a lot of strength, but the mid caps have really been underperforming anyway. This is the more concerning one with S&P growth to value. Under the moving averages, the longer we stay down here, we're in danger of seeing a death cross. Now, we're not there yet, but this was flat in Wednesday's session, and here we are going up with the S&P. We want this to be above the moving averages and continuing to go up. Now, we are improving a little bit, but we're still in the rainbow with this growth to value ratio. And we tick down just a little bit, and we're below the 50-day moving average when we look at discretionary to staples with that ratio. Not the real strength that you would like to see. Now, but then we look at large cap growth itself. We're back above all the moving averages here. So we came down, we held at the 100. This is very similar to what happened with the S&P 500. And so far, we've been able to bounce up off of that. Now, one thing I've been trying to point out is that we're improving here, but you can still see the bar pattern here. It's still looking a bit vulnerable. We have the high, then a lower high, then a lower high. We're seeing some lower lows coming in here. Now, we could totally negate that if this continues to go up and we see more buying coming in after the holiday. But for right now, we just want to be aware of this more in the shorter term. And then as far as the trend, we're still not trending in the short term. We're below the moving average. We're below 20. But for the last couple of sessions now, we default to positive because the green line's above the red line. Intermediate term also still declining. So we're not trending. Been implementing more market neutral type strategies. But we're positive with the green line above the red line here, but we're still below 20. And not surprisingly, we were quite below average here with volume. Now, sentiment, we're looking better here with the gamma exposure. Everything's green now, and we're above that 6,800 level. This had been acting as some overhead resistance. We got above that, and we're able to stay above that. So that is positive. And we're not really seeing any major overhead resistance. What we look for is the blue line here, the column connecting with the blue line that's going across. That's when it seems to be a more of an area of overhead resistance here. So we do have support if we start to drop down right at the 6,800 level. That's also a round number. And yeah, a lot of these are round numbers because gamma, which has to do with options, and these are part of the Greeks, they deal with strike prices. So you pretty much always deal with round numbers for the most part. All right, and we're still getting quite a high reading here with the Ulcer Index. There's still a lot of fear on an end of day basis, but we are dropping with the VIX. We're below 20 and declining, both with the line chart and the bar chart, and we're below the moving averages with both. Also, seeing the VIX of the VIX, the volatility of the VIX, it's been coming down as the VIX has been coming down as well, which is more positive for the market. Really dropping down here with this fear gauge, also declining with this other fear gauge. So, not our fear and greed index that we look at, that's improving, but we are seeing some of our other fear gauges show fear coming out of the market and coming down, which is kind of strange. You would think ahead of the weekend, folks might want to do some hedging. But on the daily chart, we're actually coming down with the daily equity put call ratio, but we're still going up here with the 5-day chart and the 10-day chart. So, bigger picture, there's still more hedging going on. It's still more puts being purchased than calls. And we are improving. With the risk on to risk off ratio, we had been pulling back. We continue to go up now. The bigger picture context is that this is rising and that is positive. We would like to see this continue to go up. That would be even more positive. Similar thing here. High beta to low beta. We're back to going up now. Bigger picture, we were going up after we had been falling back and seeing a bit of an improvement after a real drop off here when we look at momentum stocks to the S&P. So again, we would like to see this go back up as well. It improved in Wednesday's session, but we want to get back up to higher levels with this particular chart. And we are coming down with the volatility risk premium. So not a lot of fear being picked up by this particular measurement. Then the advanced decline line, not quite back to all-time highs, but we are improving both based on price and volume. A little bit of a trailing here. We're almost back to this previous high based on price. We're not quite there based on volume. And we're positive with the short and intermediate term advanced decline ratio. We're just barely back above zero with the advanced decline oscillator. Not showing a lot of conviction, but improving nonetheless. And we are seeing a bit more of an expansion of the new highs. Not quite as much as we saw on Tuesday, but a lot of green here and not much red. That's helping the 5-day chart to go up. And we're starting to slowly go up, but still pretty much flat here with the 10-day chart. And now our three smart money indicators are all positive. So that's looking good. We're above the moving average with accumulation distribution. Shorter term, we're above the moving average and going up with the boom indicator. And we're just barely starting to turn up here with the chicken money flow. So that's turning more positive. And we're positive with the chicken oscillator above the midpoint and advancing. And we're starting to switch over now with the vortex. The green line is just barely above the red line. You have to look at the numbers over here. We're at 0.98 with the green line, 0.96 with the red line. That's why this is now switched back to positive. This was kind of the lone holdout with our primary indicators. And we're improving across the board here with the advanced decline line studies. All the indexes are above the moving averages. And we're above 50 and going up with those stocks above their 20 period moving averages in the S&P. Now, one thing we've been pointing out is we've been seeing lower highs here. Have we finally been able to break above this previous high that we saw? There, you could still draw a line over here and see a little bit of a longer term negative divergence. But in the short term, we're above 50 and going up. That's treated as positive. We're back above 50 and climbing with the 50 period moving average study also after seeing a series of lower highs. And we're back above 50 with the 100 period moving average study. And we never did go below 50 with the 200. And that is still positive. Longer term has held up better. So it's hard to see here, I know, because we have the pivot points. They're going to be kicking into gear next week when we roll over into December. But looking better here, we're still worried about these lower highs with the daily bar pattern and then a real drop off with volume. So our 20, 50, and 200-day moving averages on the S&P are improving. And we're starting to pick up and show more conviction in the short term with the Stochk RSI. The wins for Cent are, we're not quite there yet with the CCI 14 and 20, but they are improving. And the short-term stochastic is now showing positive conviction. We're above the midpoint and going up with the intermediate short term, and we're turning up and crossing back above the moving average with the long short-term stochastic. And the force index is positive. We're above these shorter term moving averages, the 10, 20, and 30. The longer we stay up here, the more we'll see these lines start to turn and go back up. And we're improving with the short-term trend based on 20 periods. We're above the blue line and the green line. And so that's improving there because we are above the 20 period simple and exponential moving averages. And the rainbow is starting to improve. We're coming up out of it now. If we can continue to go up, the lines will turn back up as well. And we're up into the high end of the +1 channel with the standard deviations chart. So that's turning more positive. Now we go over to the intermediate term. We're above the midpoint and going up with the balance of power. And we're 1.14% based on this chart from the closing high, not the intraday high, the closing high that was set here back in October with the S&P. So yeah, we're holding up, and these bars are starting to look a lot more healthy. We just want to break this pattern that we're seeing of lower highs here. And but the go no go still more negative. Now, be aware of this. If you rely on a color scheme system like this, these charts can redraw and go, "Oh yeah, 2 days ago you should have bought," or now we're giving you a negative signal. That's why I don't really like these kinds of systems because so it's why I don't use Elliott Wave. It can come back and redraw and tell you what you should have done 6 months ago, but you didn't even see that at the time because it wasn't telling you that. And we are above the midpoint and going up with the highest high, lowest low value chart. We are improving, going back up with the lighter red here with the TTM squeeze. We're coming down, but we're still above the moving average with the speed of how stocks are moving with the standard deviation over the last 10 periods here. We're improving, but still negative with the ease of movement. We're still negative with the Arun, with the oscillator here. We're above zero and going up with the S&P McClellan oscillator. That's good. We were also seeing a series of lower highs. Are we starting to break that pattern here? So now, when the McClellan oscillator is above zero, the summation index is now going up based on price and volume. That's positive. And we're above zero and going up and showing an improvement here with the NYSE McClellan oscillator. So we're going up with the summation index based on price and volume for the NYSE. The swing trading oscillator, which has hung in there and been pretty positive over the last number of trading sessions, that it's above zero and going up, both based on price and volume here. We are improving with momentum, but we're still negative. Trying to turn up with the PMO, crossing back above the moving average based on price, but we're not at the moving average yet based on volume. Little bit of a negative divergence there. It's more positive if we see volume leading price. And this is the one that's extreme. The PMOs that are rising, we're getting to an extreme reading, but that's positive and it could still go higher than where it's at right now. We're above 50 and going up with the buy signals, and we're turning back up with the PMOs that are above zero. These are all the PMOs inside of the S&P 500, and so they are improving. And we're positive with the Elder's Impulse system. For 2 days now, we've been positive with the parabolic SAR. Now, in the short term, we're crossing back above the moving average with the slope oscillator. So that's actually switched back to positive. More short to intermediate term, the MACD, we're improving, but we're not back above the moving average yet. So we're turning more positive here in the short term. With the TSI, the True Strength Index, it's not quite back above the moving average yet, but certainly they're improving. We are improving with the three intermediate term oscillators. We're still declining with our two longer term oscillators. And we are improving, but we haven't crossed positive with the Copic curve. We're showing good follow through here with the Sean trend meter. We're getting to the high end of the green area. We start to get extreme if we go above the red line. We get really extreme if we keep going up and go above the blue line. We're improving, but still below 50 with the money flow, where we're starting to cross slightly back above 50 with the ultimate oscillator. On balance volume is still positive here. We're crossing back above 50 with the intermediate and short-term RSI. So that's showing an improvement as well. And we're turning positive even more so with the bullish percent index for the S&P. We were already positive, but now we saw a nice little upthrust here. These are point and figure buy signals that are being generated inside of the S&P, and we're crossing back above 50. So we're seeing more buy signals than sell signals right now. And we are improving with the NYSE bullish percent index. We're back above 50, and we're right at 50 with the NASDAQ 100 bullish percent index. So all three of these are improving, and we're trying to improve with the intermediate term trend. We haven't quite broken out above these lines, but they're starting to turn back up. This is based on 50 periods. When we are now for 2 days back above the 50 period simple and exponential moving averages, that has turned the intermediate term trend back to positive. So Now we've been drifting down with the 20 period moving averages, and you see kind of a spaghetti mess in here, but we're above all the plotted moving averages. So that's why we're positive on all three time frames. And coming back up out of the rainbow with the intermediate term, based from 50 periods up to 100, we didn't spend a lot of time down here. Now the lines are slowing down a little bit, but if we can stay above this, the lines will smooth back out and start to go up, and that'll show more positive conviction in the intermediate term if we see more follow through. And we're back to being more than 10% above the 200-day simple moving average with the S&P. And again, because when we get to that level, we start to top out at some point, and that has produced more meaningful declines. We didn't see one here. We fell, what, 5.5% or so from the high down to the low that was set a week ago on Thursday, and now we're coming back up. I mean, that would be kind of a pretty muted pullback if this is as far as it's going to end up going. Now, support, we're above this little mini rainbow here when we look at the 20 period simple moving average of the open, high, low, close. Now, we just kind of came back up. These lines didn't really provide all that much in the way of resistance. We stopped in here, but now we're coming back above the rainbow. The more we stay above this, the more the lines will start to turn and go back up, if that's what happens. And this is turning out. Now, we still have Friday, and we don't know what's going to happen, but as of Wednesday's close, we're up 3.17% with the S&P, and the weekly chart is showing some improvement here. We're also a little bit worried because we came down and set a lower low, and it was ruining that nice little pattern of higher highs and higher lows here with the weekly bars. But if we can go back up and continue to advance from here, it would totally negate that, but we don't know if that's going to happen here. And from a trend perspective, we're looking more positive. The Heiken Ashi is positive. We're black and pointing up with the Kagi chart. The Renko chart is now switched back over to positive, and the three line break is turning positive even more so. So all the different ways that we measure the trend are looking pretty solid right now. And we saw enough of an up move above 6,800 to put in a new green X. There's still no signal that's been triggered here, and we're kind of bunched around some recent prices, both going up and going down. But again, anytime you see a new green X, that's positive since we're going up. Long term, we are going back up here with the 150 and 200 moving averages. That's longer term positive. And this is the Zwag NYC breadth thrust, where back on November 20th, which was last Thursday, we had a pretty big down day and we got an extreme negative reading. Now, we'll have to see. We need to get up to this red line by December 5th. So we still have some time, but this is delayed by one day. So we're not going to get Wednesday's action until Friday, and we won't get Friday's action until Monday. So we'll see if this ends up being something. And other times when we did have a confirmed Zwag NYC breadth thrust, it was very positive for the market after that. But we don't even know if this is going to happen yet. We're just watching this. And then we're back to positive on all time frames with all the different stock indexes. And we're still negative in the long term with the dollar, but everything, it's like buy everything right now. Everything seems to be in uptrends. And the only sector that ended up being down was healthcare, but that's been the best performing sector in November, up around 10% or so. So yeah, I might be seeing a little bit of profit taking there. Now, utilities, again, you could put that in the growth area because of AI and electric vehicles and so forth. Materials saw some improvement, but then we see tech and discretionary did well, and communication, not really strong there. These are the three big growth areas when we look at tech, discretionary, and communication. And everything is green. It's like St. Patrick's Day here. So we had the NASDAQ first starting out at 23,000, dropped to 22.9, then went up to 23.1. We got above 6,800 with the S&P, NASDAQ 23.2. So yeah, a lot of positive things. We had a BPI cross above 30 with tech. That had been under pressure lately. Now, the financial sector, seeing a bullish MACD crossover, we like that. We're seeing a BPI cross above 50 with discretionary. Canada's doing well here, it's setting highs. Utilities, it's like everything's improved. BPI cross above 80 here, a BPI cross above 50. I showed you that earlier on with the NYSE. And the financial sector having a BPI cross above 50. So a lot of technical improvement here. Staples, BPI cross above 30. and we got a back above 50, which I showed you for the S&P. Also, the bullish MACD crossover. I'm not seeing that. We're not there yet with the MACD that I follow. So that's a little more liberal than I am seeing currently. And then we saw a bullish MACD crossover with the industrial sector. Okay, and lots of green here, except Google kind of decided to be the party pooper here. But we have Nvidia, Apple, not real strong gains, but green, where you had Broadcom and Oracle. They were holding up more of the tech side of things. And the financials, seeing a lot more green in here. Discretionary, Amazon was down slightly, Tesla was up. Healthcare, seeing a bit of profit taking. And then a lot of areas with industrials, utilities were green, real estate was mostly green. They liked the idea of a rate cut as well. Staples, like Walmart, getting ready for all that Christmas shopping, and are seeing some improvement here with energy and materials. So a lot of green, except for the big red here. It's kind of sticking out. So we are improving. We're up almost 2/3 of a percent with the Dow above its 50-day moving average. Positive with the Elder's Impulse system. Hard to see here, but we are hitting overhead resistance at this pivot point for November with the NASDAQ. And that is about as high as we went. But we are positive since we're back above the 50-day moving average. Positive with the Elder's Impulse system. Not quite up to this overhead resistance area here with the NASDAQ 100, but above the 50-day moving average. And positive with the Elder's Impulse system for the Qs, improving, but still negative with the momentum for the NASDAQ 100 and back above the short-term 20-period moving average. We were not there after Tuesday. Now with the Qs, we're back to looking positive on all three time frames. And up here, right at this pivot point, this is about the previous high that we saw before small caps started to turn and go down. Are we going to be able to break out this time? So, well, we've been faked out so many times along the way, especially here with the S&P 600 small caps. We're above the 50-day moving average, not back to these previous highs yet with the Russell 2000 small caps, but positive with the Elder's Impulse system. Mid caps above their 50-day moving average, and not. This has still been the worst performing index for a lot of 2025, but for right now, we're positive with the Elder's Impulse system. Still climbing up above the 50-day moving average of the Wilshire 5000 and the total US stock ETF, back above and hanging above the 50-day moving average with the FANG index. This is what we want, but we want to see this really going up. These are the big, big stocks, and we want them to take a leadership role. That's when the market is really in gear and going up. But in the meantime, we're still positive anyway. So Apple's up fractionally here, and it's been holding up quite well. We're back above the 50-day moving average with Amazon, even though it declined slightly. Bouncing off of the 200-day moving average with Microsoft. This was one of the ones that, oh, they're spending all this money on AI. Came all the way down to its 200-day moving average, and so far has been bouncing up from that. Where Google held up quite a bit better, but you saw some profit taking there. That's why those big blocks were green on the market carpet chart. And then Meta, it ended up being down. We're kind of getting close here to a death cross. We're going to need to get back above both of these moving averages for that to possibly be negated. And Nvidia was up 1.37%, but not back up to its 50-day moving average. Improved here with Tesla, but still below its 50-day moving average. And Netflix, it actually bounced up here. We're getting really close again to possibly seeing a death cross with Netflix, where it had been in a really solid uptrend going all the way back to late 2022. And the Dow Jones Semiconductor Index above its 50-day moving average. We like that. That's more positive. And we're above the 50-day moving average with the SMH Semiconductor ETF. So we're seeing confirmation there and some improvement. And so we're going back up. We haven't broken out yet with the semi to tech ratio. The bigger picture is that this has been going up, and that's positive. This is when we were pulling back, and when we saw this ratio coming down. We want this bigger picture positive ratio to continue to go up to be more positive on the market. And we're still climbing a little bit further above the 100% level on the distance from the 200-day moving average with the Dow Jones Semiconductor Index. And that's when we start to look rather extreme. And we're seeing a bit of a drop off here as the NASDAQ 100 has been improving. Bitcoin's trying to go back up, but it's been underperforming. And that's why we're seeing this trailing off here with the correlation between Bitcoin and the NASDAQ 100. And we are improving here when we look at the bellwethers, starting to go back up with the semiconductors, improving with the home builders. They like interest rates coming down too, going back up with the transports. We'll see if everybody makes it through the holiday weekend with traveling. And we've been going back up with retail heading into, Friday's Black Friday, and we're going to be in that season again here. And the regional banks have also been improving. So we are seeing the bellwethers improve. So yeah, some positive price action has been coming back into the market. And we're up a little bit here, over 1% with oil, but we're getting into the mid 58 range. And we're still below zero, excuse me, below 100 and dropping now with the US dollar index. And we're just a little bit under 4% here with the 10-year yield. And that's more favorable for stocks as well. And we continue to go up slightly with the 10-year based on price. But we're still negative in the bigger picture with our growth to value ratios, even though they're improving with the Qs to S&P, discretionary to S&P, large cap growth to large cap value. We want these to be going up and want the moving averages to be going up as well. And that's not quite happening yet. And improving with the large caps, mid caps, and small caps. We're finally getting a little bit above the moving average with the small cap growth to value ratio there. And we still have this Hindenburg Omen in the background. We had the initial signal on October 10th. We've had a series of confirmation spikes since then. And then this is about 6 weeks out from a calendar basis. And then if we get another spike, then that starts the countdown again here. But we saw this at the end of 2020 or beginning of 2020 with the COVID crash, the end of 2021 before the bear market. Now, this doesn't mean this is going to happen, but we still want to look at this, respect it, and just be aware of it for right now. So the outlook, again, Friday is going to be a shortened session. It'll close at 1 p.m. Eastern, which if you're on the West Coast, I always love these days. It's 10 a.m. It's like, hey, I'm done for the day. And we're positive on all three time frames. I don't know about the economic reports that'll be coming out. The calendar, as I've been saying over the weekend, I'll try to sort this out and see if we can get something that's a little bit more organized for what's going to be released. And then, of course, because of the holiday weekend, of course, it's family, friends, food, and football. Let's just hope that nothing too crazy happens. I mean, crazy things always happen, but let's just hope that we can make it through this weekend without anything major. And the calendar I've been kind of ignoring. Now, when we look at Friday, though, for the 28th, we're neutral to positive with the Dow, going back to 2002, but we're neutral to negative with the S&P and NASDAQ. So not really much of an edge there. Friday will be options expiration. Now, if you're holding some positions, you've got covered calls, you're doing some options, you're doing some option strategies, it's going to close earlier. So be aware of that if you're still holding on to some things as we get into expiration day. But we do end up being up more than down when we go back to 1980. And then here's a little bit of not really much in the way of positive seasonality, a little bit of an uptick here for the last trading day of November. And this is a newer chart here, and I don't know what this means. Late November, gonna late November. Okay, there must be some hidden meaning in there. But we typically will see some positive seasonality when we go back to 1950. Now, the chart that I just showed you, that's post-election years because they slice and dice all this information and then break it out into different categories. But here, now we only have one day left because we don't have a 29th here or a 30th or anything like that. But this is more positive as far as seasonality. And this is also, and we might have a shot. If we have an update on Friday, there might be a chance that we may have November be an up month. We'll have to see how that goes. And positive seasonality, we'll see if that carries over into December. Also, some positive seasonality here after the Fed came out and did their rate cut. And this also shows positive seasonality here going back to 1928, and then taking a bunch of cycles and putting them together by NDR. That also shows positive seasonality going up into the end of December. Also, positive seasonality for November, no matter how you slice and dice it. All right, so we're still concerned in the shorter term with the growth to value and discretionary to staples ratios. But we've been watching that now for quite some time. We're just wondering, once the holiday gets back over, or we get through the weekend and then everybody comes back next week, is that going to kick back into gear where the market is going to be switching back to looking more defensive? We don't know that yet. We're just going to be watching for that. Now, we're still negative with our oscillators, but we are improving. And the short term one is actually crossed over positive, but we're not seeing that confirmed by the other short term. The slope is positive. The TSI is not quite cross positive, but all of the oscillators, except for the long term ones, are improving. The money flow is still negative, ease of movement is still negative, and the momentum for the NASDAQ 100 is negative, and we have this confirmed Hindenburg omen that's still there. Then on the positive side, our three smart money indicators are now positive, and in the longer term, we still have uptrends with growth to value and discretionary to staples, and we're looking more positive here with the S&P and NYSE McClellan oscillator and summation index. Swindler trading oscillator is positive, as is the parabolic SAR. The bullish percent indexes are looking more solid there. The vortex has just switched back over to positive. The ultimate oscillator crossing back above 50. And we're still in an uptrend with the financial sector. I haven't been showing these. I'll show them over the weekend to see. We're not really seeing any change when we look at the performance of the financial sector to the S&P. And then our longer term special K chart is still positive there. Here are the pivot points for Friday's session. And then the conclusion. Really haven't changed much on all three time frames. Where we're above the 20, that's positive in the short term, above the 50, positive in the intermediate term, way above the 200, that's positive in the long term. And we are seeing some improvements, but we're currently not trending in the short and intermediate term. Thank you. Again, have a wonderful Thanksgiving, and I will talk to you in the next video.